why people bring me in is I maximize the internal rate of return to the investor by using tax dollars to maximize it. And one of the things that we do, and one of the key elements as we begin this, is purchase price and valuation. And over my 10 years, I watch the newspapers and I read Forbes magazine, and I hear things like this. Manchester, this is the Forbes source of information. The top 10 valuations of sports franchises. Mr. David Gill was here yesterday as a speaker, and the leader of this worldwide is Manchester United, Dallas Cowboys, New York Yankees, Washington Redskins, Real Madrid, New England Patriots, Arsenal, et cetera, et cetera. Then you look at the value that's put on it. Where did Forbes get that $1.86 billion valuation? And what data did they have to get there? And I've never figured that out in my 10 years, okay? In the process of valuation, evaluation is used primarily to determine fair market value. And I look at these things. Some of these transactions I may have been involved with or not been involved with, but I look at the teams. These are little spurts that I got from newspaper articles after franchise had been sold. The NBA Board of Governors on Wednesday unanimously approved Michael Jordan's purchase of the money-losing Charlotte Bobcats from Bob Johnson. The acquisition placed was $275 million. Didn't know where the commissioner got that number, and my curiosity always went, how did that happen? Houston businessman Jim Crane buys the Astros for $610 million. Where do these numbers come from? The 76ers, $330 million. Okay, so I keep it was valued by Forbes, and then it was reportedly sold for $280 million. Now this one, which is now the prime of the news these days, is in 2004, McCourt bought the Dodgers for $430 million, and now it's said to be selling between $800 million and $1.2 million. So as a tax guy and a businessman and an accountant, I wonder where these numbers have come from. So in depth, I've done valuations, and primary valuations that I started doing in 2002 were primarily motivated about tax returns, okay? How to get the most value to get the biggest write-off. And prior to October 22nd, 2004, which is a tax guy's nightmare in the sports business because they enacted that sports franchises are now subject to 197, it put us to go to what's from old facts and circumstances depreciation now to Section 197, which puts it at about, over a 15-year period, about 6.7% amortization per year. But our objective, and when I come into a transaction, is I want to get my investor the highest rate of return on his investment. So valuation is extremely important. How do I get to valuation? Well, a valuation is what people, you do a net present value of all the assets. You look at the cash, you look at the working capital, you take all the contracts, you do net present value discounts, and you come up with the value of what the franchise, its assets. If it has an arena or doesn't have an arena, that's something to be determined. Then you come up with a valuation. And the valuation's in order to determine the fair market value. And when you get to the fair market value and the owner wishes to sell it, he comes up for a price. Then he comes up, once there's a price and there's a willing buyer and a willing seller and there's a closed transaction, it comes up with a purchase price. Now, everybody tries to determine what a definition, we're going to go through the definition of a valuation, which we kind of went through really quickly. And then it said purchase price. And as an accountant, we play with numbers. There are actually 4 different purchase prices for a purchase price when a sports franchise is sold. The contractual definition of a purchase price, the GAAP or financial statements purchase price, the tax basis purchase price is which one I really care about, and the 4th is whatever the league says it is, okay? Which is kind of a big determination. Normal contractual purchase price. You see a lot in contractual relationships when transactions are closed. You see a definition of purchase price defined under a contractual arrangement. And it's usually, they use this term enterprise value, and then they come and they adjust enterprise value by working capital adjustments. And then there's cash payment plus liabilities assumed. That equals purchase price. Now, one of the things that I wanted to mention today is I have two clients, both in the NBA. And one of the clients was a partner in one NBA franchise and then bought another franchise for himself, which he became the substantial managing partner. And in that process, there was two announcements of purchase price, one in the year 2002 and one in the year 2011. And during that time, the owner came up to me and he says, "Boy, did I pay too much?" And I said, "Well, the announcement is you paid way too much, but you really paid less than the transaction in 2002. And the reason was, in the 2002 transaction, it was the way the purchase price was determined. That particular seller wanted all the cash up front and said, "Listen, you pay me cash in my pocket and you take over the operations." So if you take the cash he paid plus his liabilities assumed, you got his purchase price, okay? Then the other purchase had to do with a sophisticated enterprise value plus a working capital adjustment. Well, the first price was $360 million and assumed liabilities of about $100 million. On the very first second transaction, they had a working capital adjustment, but the actual capitalized purchase price was $420 million. But the NBA announced the first project in 2002 was a purchase price of around $380 million, and the second purchase price was announced in excess of $460 million. But the price and purchase price did not change. One of the important things is once you have purchase price is how that purchase price is established. And purchase prices, if you see a balance sheet, it's usually the right side of the balance sheet. Now you're going to allocate that purchase price to put a value to each of the assets. And each of the assets are determined by doing the fair market value of the assets. Now, prior to 2004, before we used to use facts and circumstances depreciation. And if you ended up with a value of $360 million, you would take that purchase price and you would allocate it to all the assets. Well, how do you value the assets? Well, cash is easy, receivables is easy, the current assets are easy. But we used to do something that was quite clever, and we used to value the players' contracts. And what we would do is we'd take a roster, and we'd get an expert, and he would take it and say, this guy's worth this amount of money, this guy's worth this amount of money, and then we would take the difference between the fair market value of the player and the obligation of the player's contract and depreciate it over the life of his contract. And prior to 2004, we used to amortize purchase prices between 3.5 and 4 years. So if you buy a team for $300 million and you have an amortization of $300 million over 2 or 3.5 years, that means you've written off $300 million. And if you have clients that are in the 50% tax bracket, we just put $150 million in that investor's pocket, and which is a 50% after-tax return. So that's very motivating for the owners to buy that franchise. So that part of our job is when we come into it, besides doing the bank and gap valuations, is to go in and identify assets to accelerate deductions as fast as possible in order to take advantage of the write-offs. And the allocation of the purchase price is the single most important exercise to get there. Recently, in sharing some experiences with you, I have been asked by a Northeast sports franchise, I gotta watch my confidentiality agreement so I don't throw names around, who is having some financial problems. And they came to me and they said, we need to raise money, we need to resuscitate the franchise. How can we do it? And what investor would ever come to get involved with this franchise? I said, how about if we get them in for free? Okay, how do you get them in for free? Well, if we determine that the goodwill of the franchise is worth $300 million, okay? And we can amortize that over 15 years. We're roughly getting $20 million of depreciation. The negative cash flow of this franchise is $10 million per year. So this particular investor coming in, we said, you put up the negative franchise up to a sum, let's say $50 million over the next 4 or 5 years. You get 100% of the losses from the franchise, and you'll invest. He said, wow, so I had $10 million a year to cover the loss. Yeah, well, what do I get in losses? Well, the negative cash flow in Ruffy is $10 million, which is mostly deductible, ordinary, necessary business expenses, to $20 million in depreciation. We hand that investor a $30 million per year loss. He puts up 10. He's in a 35% tax bracket. It's free. You know, this federal government, Mr. Obama, just helped him buy a franchise. Okay? And that's what we do. We make sure and try to give the highest rate of return. That is a very special case, but it allows this particular franchise to resuscitate itself, bring in new management, work the numbers, get it into a situation. And eventually, this person may make money on top of that. Okay? May. Okay? So you look at it, and then when he sells it, he'll have some capital gains, so he will have a little bit of ordinary recapture. But what is his rate of return? Okay, and it's a way you look at it. You could draw that in about 50 different ways. His rate of return could be infinite. And so these are some of the things that you see in the sports franchises. And we've done that particular scheme probably about 5 times. And I'm very curious when this transaction closes what the commissioner is going to announce what the purchase price is. So now I'm going to open it up for some questions. And I think it'd be nice to stay open forum. And if you have any questions regarding regarding specifics to this, I'd be glad.
So, over the past couple of years, surprisingly, locations like the city of Miami and recently just Sacramento, they put in a lot of public dollars to fund an arena. So there's opportunity costs in there. And regardless of where the appropriateness of spending public tax dollars on a private business, how, as in your valuation exercise, do you value the ability to extract money from the public for a private enterprise?
Ooh, that's an interesting question because it's a question that I have in the example that we just talked about, and how you do it. Usually, you don't have to pay for the arena. The arena, you kind of, when you value the sports franchise, you just value it as a rent and you use that as a facility. So it matters if you own the arena or not, or have any profitability in the arena, or how you run the arena. You know, we see specific examples when we're trying to value a franchise where, you know, they're just basically leasing a space for 2 nights a week. One particular team I have doesn't pay anything for their arena. Okay, so for them to own something, it just brings them management burden. Unless the arena can make a profit. And I've talked to some of the, especially over the last few years, some of the most biggest experts, even some of the people at this conference, is does an arena make money? I haven't seen it. People tell me they do, but I haven't seen it. So I think there's a burden for a team in a sports franchise, getting specific to a sports franchise, is to have to own and operate an arena. But some ownership and management like to do that because they can control their own facility, which gives an advantage to it. So it's really not really part of the valuation unless there's an ownership interest in it.
When you're over here, when
I
you're
can't
doing,
see it. It's like bright lights everywhere.
when you're doing your valuations, what are the discount rates that you normally apply, and what kind of factors are you putting into that discount rate calculation?
That varies on opportunity costs. So you're talking about the capitalization for doing the net present value of a discount. You have to look at the economic environment surrounding you at the time and the inherent risks that are in the particular investment. So, one of the things you want to look at is you want to look at what the opportunity, what the current lending environment is. It's a science that you put together to trend up with this discounted cap rate, and it's changed over time, and they do what's called build-ups to try to get to that. And I'm sure there's some accountants and valuation guys in here. But, usually in the old days, we used to just say, okay, 20% because that's a risk, 5 times, EBITDA, and you discount it back. But now it's much more complicated, and it has to do with many factors, including the tax factors that are built into it. Yes?
My question has to do with franchises that intend to move after ownership buys them out. So in the Bay Area, you have two teams now that are looking to move from their current locations. You have, the 49ers with their new complex in Santa Clara, and supposedly, with ownership's approval, the A's would be moving to San Jose. And the example I always have is the Sonics moving to the Thunder. What is the Sonics moving to Oklahoma City to become the Thunder? What is the valuation that you put on that an owner would put on moving a franchise to improve the value of that franchise?
Well, that's how we would approach that in a particular instance. And you're using, if you want to use NBA or Major League Baseball, the local teams have certain rights to certain income, okay? And there's national rights, such as like national broadcasting shared evenly among a lot of teams. So what you do is you would have to look at the particular region you're moving into and see what that will do to your positive cash flow. Can you sell more tickets? So it's management judgment to kind of move it to do, we take management's analysis of that movement and we would discount it back. And you would probably see a substantial increase in cash flow, and that's why they're making the move. The big play that we're seeing, and one of the big stuff going on in the valuation, which we'll get into in this seminar, is how these local broadcasting rights. The local broadcasting rights is the big gem of NBA franchises, Major League Baseball. You're seeing it substantially, and I know the local team in this town just did a substantial deal in the local broadcasting thing, and that's where the big meat is in these franchises. It's strange because you bring up an interesting topic when you do that, because the accounting profession, which I am a part of, is very confused. Okay, for the first time ever, we say. And they're getting into this concept called fair value accounting. And I'm an old tax guy, and this fair value accounting has me in a loop. And when we have one particular instance to where someone's forming a broadcasting network, and the auditors are now saying that when they formed this broadcasting, they create a high fair market value of what they received in this new partnership, and they record it on the books as an asset, and suddenly you have this franchise that has $300 million of cost basis, has $1 billion asset valuation. Because what GAAP's requiring us to do is take the contribution and value the contribution, which is also based on the net present value, book an asset account for that venture, and then have to have a deferred revenue number for that, and then amortize it over the life of the joint venture. And it's so confusing that in every particular instance, everybody handles it different. If you had 4 valuations performed by the 4 big 4 accounting firms, all 4 valuations would come out different. We recently did one for a West Coast basketball team, and we were doing the valuation, our group was, and they had one auditor and they changed auditors, and we did one valuation, and then the new audit firm came in and they wanted their valuation, and they didn't like the valuation of the other one. 2 entirely different values. Then the question is, who's right? Okay, it's whoever who's right is the one that's going to issue the report. Okay, but right now our profession with this fair value accounting is having a lot of issues. From us tax guys, our job's fairly simple in the sense of purchase price allocation. We take working capital, we take fixed assets, we take the difference, and it goes over 15 years. Our game has ended, in the sense of purchase price allocation, about trying to get a high rate of return for accelerating faster deductions, such as player contracts, but it's very simple. Now, most valuations that are done in the sports industry are not done for tax purposes. They're done for GAAP purposes, because tax is getting very basic. But one of the 25 transactions I've been involved with since 2002, every single transaction has a purchase price problem. No one has ever agreed on purchase price. I almost walk through it with the lawyers now and say, well, let's have a purchase price dispute arbitration clause, okay? Or let's just have it in the beginning before we sign the contract, because it's going to end up that way. Because there's always a dispute of what working capital is, what working capital isn't. But the interesting thing that you have is financial statements, especially in the sports business, is completely different than income tax returns. You literally almost have 4 sets of books in a common sense. You have GAAP basis, you have tax basis, you have NBA accounting, or whatever the league it is accounting, and you have management accounting to determine how they can operate the business. And, it is entirely different. One of the things we come in and I could review any sports franchise initial tax return, and I could find significant errors in it. It's almost like reading an x-ray now, because you know right where to go. But, the primary thing is for all the students out there that are trying to figure out what is purchase price. Purchase price is cash, the cash you give up, and the consideration you give away, plus liabilities assumed. A lot of the disputes that we experience are in what liabilities assumed. One controversy we have continually that's been going on since the 70s is deferred revenue. And from a tax basis and what's been going on with the tax basis. And, we know it exists under the Internal Revenue Code, because it goes back to 1913 when the initial code is. If someone brings cash is under this code section 451, I promised I wasn't going to get too technical, a taxpayer is to recognize income the earlier of cash received or when the income's earned. Well, in the sports business, you receive a lot of your cash up front. Your deferred revenue, it's, you debit cash, you credit deferred revenue from season ticket sales. So sometimes if you buy a sports franchise at the beginning of the season, you could end up with a number on the balance sheet up to, 80 to 100 million in deferred revenue. And what happens is the buyer has cash in the bank of 100 million, or doesn't. He usually spends it, because that's what people do. They spend their money in the sports business. So the purchaser assumes, from a GAAP point of view, the obligation to perform that service in the future without any cash income. And the dispute for GAAP, it's clearly deferred revenue. But for tax, the question is, wow, whose income is it? And we have a significant dispute going on everywhere regarding this. So everybody says, well, what's the answer? Well, who do I represent? Okay? If I represent the buyer, I got a good answer. If I represent the seller, I got a good answer. The hard thing is when you're the buyer and the seller's taking the position that you took 2 months ago. Okay? But, from a sense, there's authority for both of them to do that. Because there is some GCMs out there, which are general counsel memorandums, that allow a cash basis taxpayer that purchases a team to be deemed to have paid that deferred revenue as a part of the purchase price over to the other party. But it's kind of an assignment of income doctrine for tax reasons. The one thing is, back to the point on arenas, and in the particular instance I'm working at, if you're involved with an arena, it does allow us a lot of flexibility in the purchase price adjustment, because what we do is instead of being stuck with that 15-year amortization, we have this particular arena that we're dealing with now. The arena is actually owned by the local municipality, but the improvements inside are actually owned by the team. So in this particular instance, in the purchase price allocation, we're focusing on all that tangible property. So we're doing what's called a cost segregation study to try to move part of that purchase price, right up front. So, there's a lot of developments. Yes?
Yeah, can you talk a little bit about evaluating a minority, non-controlling interest? You read a lot about the Mets, the sale that fell through. Maybe you can comment on that. Now they're trying to do it in bits and pieces, but if you could just give me some thoughts valuation-wise on that.
Well, that's right, and I'm gonna be bipolar for a second, okay, in the sense of that, because when you value that interest, I have two different arguments in how to value that interest. One from the sense if you're the buyer, and one if you're the seller, okay? Usually what you would do is you'd find out the value of the franchise. You do a valuation of the interest, try to determine it. Sports valuations are very emotional. It's a little bit, if they weren't sports, a lot of these wouldn't sell. There's a real vanity to it. And I just read, and I don't want to get off topic, but I'm brought in a lot to convince wives that husbands aren't being stupid buying a franchise, okay? Because I'm going to give this tax rate a return. So I spend more time with spouses on sports franchises than you could imagine. Yes, oh really, we're going to save this amount of taxes, yes. And when that K-1 comes in, and if I'm not right, that wife is all over me, okay? Like you wouldn't believe. And sometimes a husband in some cases, okay? But, back to your question is, you do evaluation of the franchise. Well, usually what someone would tell you, there's some investment bankers in the house, so they'll tell you, they'll come up with a number and they'll negotiate it. But usually what the proper thing would do is do evaluation of the franchise, not based on the previous, well, do you hear the Dodgers are selling for $1 billion. Well, therefore, this should be worth $1 billion. Well, it's apples and oranges. So you have to take do a net present value, figure out what the valuation of the franchise is to determine the fair market value. Okay? And then if I'm the seller, I would take that number and I would times it by my percentage, okay? And I'd say this is what I own, because if the project was to sell it, I would get this if you sold the whole franchise. So this is my entitlement. Give it to me. No, well, then you're at what's the Well, you're now the buyer, okay? And so you say, well, what should I do? What's the value of that control? The evaluation groups, the business valuation groups, all run around with their discounts. Okay, is it 25%? Is it 35%? And then they have another discount called marketability discounts, because it's not a marketable asset that you could sell on an exchange. So when you look at those two, you're looking at a 55% discount some people take on the actual fair market value of the interest. So that's what the going rate is. Okay, we as valuation guys, now I'm going to put on a different hat, okay, and get more. And this is a detailed business. Okay, we can get into details, and I can save my clients tens of millions of dollars. Okay, and we have one particular interest, which is not in the sports industry, which a family, they have a death in the family, so we have to deal with the IRS on valuation issues. And in the law of sports franchises, they have partnerships that are part of the assets that generate income. So one of the things we like to fight is we say, okay, this one has investment in NBA media, or investment in some. So we take, when we do a valuation, the aggregate value, the entity valuation, not the aggregate valuation, we do discounts on the partnership interest that the team has internally. So we say, okay, if you're an NBA partner, you're not in control. Same thing you're saying. There's no marketability to it. You got restrictions. So even though the net present value of the cash flow should be discounted even further by a lack of marketability and controlled discounts. So you almost get a double dip. So now there's a controversy with the IRS. Can you double dip? And how you double dip, okay? And that's kind of some of the issues that we're involved with every single day. So, we have to, we try to take the position that's convenient at the time with us. We try not to stay in the moral interest, because we have to act in the best interest of our client. So we identify this. On the Mets situation? Well, my address is 140 East 45th on the 25th floor. Einhorn's on the 24th floor, okay? So he's a little below me, okay? Okay, but no, I'm not surprised. I didn't understand I'd read the articles. I wouldn't understand a lot of it, okay, what they're trying to do. Some participating loan, it seemed too good to be true. And why would Wilpon be trying to sell give so much rights to really a potential lender? And the Mets have a lot of intrinsic value to a lot of people with a lot of money. And I thought he could have done a lot better going to few people than to one person to try to negotiate a deal. So I wasn't surprised at all.
And that's what he's doing now.
Yeah. Yeah. Great.
You often see when players are signing big free agent contracts with sports franchises for amounts that maybe if you just consider sort of the expected amount that a given win or two that a player would add to a team would improve the team's revenues wouldn't be worth it. But you'll often at least see the agents say, well, but this player adds so much more than his on-field value. Think of the branding, think of the marketing, think of the jerseys. In all your experience, what magnitude does sort of quote unquote marquee value have? How much better off is a given team with one superstar than with 5 no-name players who contribute the same amount as far as its effect on the franchise valuation if they were to sell?
It's all about winning, okay? And if you win, ticket sales. There's, and I always got to watch my confidentiality with teams, but there's a team that I work very closely with that made a a decision a few years ago that they're in a very sports fanatical market, okay? And there's few of those, okay? In which their team was doing mediocre under its old ownership group for 15 years. It had a legacy that you couldn't believe in championships. But this community was getting bored of not winning. So this franchise had to make a particular interest that the ticket sales were going like this. And so you say to yourself, you say, okay, what is going to be our, we'll use this term EBITDA, which has a lot of ambiguities in the sports business also, okay? So you say, what is going to be our cash flow if we lose and we stay in the same mediocre, kind of like a Clipper attitude? You just, every year you do the same thing, you sell off your marquee values and just kind of milk the cow, okay? And keep the, or do you take the chance to invest in some good players, bring in a championship caliber team, bring in to start to win? We did a net present value analysis, and we did announce that if the cash flow for this particular team continued the season, they would lose $4 or $5 million. If they brought in these, I'd give it away if I said the name, if they get in 2 or 3 superstars to come into this particular team, there's a strong likelihood ticket revenue is not going to decline. You're going to resell the boxes. You're going to resell the corporate boxes. And this particular team invested that if they stayed stagnant, their EBITDA would almost go to a $20 million negative. But if they went to one playoff and got their ticket sales under their projection, they would break even for bringing in those 3 players. That team brought in these players. This team won a championship. This team now is a marquee franchise again. It's picked up its tickets, it's picked up its marketing base, and it's just done one heck of a good broadcasting deal locally because it's now back to the pride of all the other teams in that region. So it's a bet. You know, they could. Well, certainty. You know, if you how many Jeff Lynns appear every day? You know, if you go out and you don't win money. If you're a Boston-based team, and using this locality because someone brought up Green, and you're not winning, first of all, the owner can't eat in any restaurants because they'll be attacked, okay? You know, people will lose interest. You'll just become, you have to win. Certain cities, Philadelphia, Boston, New York, they need to win. And if you could bring a situation to where you can get 5 guys, to basically it's like what's the University of Michigan years ago, where you just, or even 3, the guys that bring you to a championship and make your ticket sales. That's the best bet because you're not paying them anything. You have to worry about it next year when they start renegotiating. Look at what's going on in New York City right now. To get a Knick ticket, I think you have to give up your first and second born. Just because of this Lynn mania. So having marquee players is important. The question is, do you develop them or do you buy them? So did that answer your question a little bit? Yeah.
Hi, thanks for coming.
Thanks.
Would you describe in more detail how you build out the fundamental cash flow forecast? What are the drivers behind it? How much of it tends to be ticket sales versus the premiums on players' market values versus contracts, broadcast rights, that sort of thing that you've touched on, but it would be good to hear how you really build it out.
Well, there's and there's probably some in this room, there's a lot of consulting firms making a lot of money off doing that analysis. And what on our part is we don't get into that analysis. But we do in the sense of we look at the end analysis and look at the net present value of it and we look at it up. But a lot of it is the best source that we use for determining cash flow is the previous year. And if someone has a previous year cash flow, we know that certainty, that's a certain number, they've done it before. And then we'd look at factors that look at the previous year's cash flow and we'd see what change are going to be made by management in bringing new players, not using players that would increase the cash flow. You know that if you're going to bring in a marquee player, that people want to see it. It's like this team that played the Celtics last night. I couldn't even name the starting lineup until last night when I saw it on TV. I couldn't even name a single player on the team. And the ticket sales. That's right. That's right. I watched the Kardashians. I didn't know he was on the team anymore. I thought I got traded to Minnesota. I'm only on episode 4. Okay? Yeah. So, New Jersey's a team in transition. That's going to be an interesting development on what that franchise value is going to be, because right now it's kind of like it's sitting in the Prudential. It's playing out there. There's an owner, and they're moving to Brooklyn. And it just doesn't seem to be a high-level team. But when that team goes to Brooklyn, and if it's established in Brooklyn and it makes money, and they bring in some marquee players, that's going to be an excellent franchise. There's a lot of upside. But can a team make it in Brooklyn? To be determined. In Manhattan, which I live now, but I have roots in Boston, if anybody's been to the Rock or the Prudential Center, it's a beautiful facility. And any team that would ever want to play would want to play in that facility. The problem is it's in Newark. Nothing against Newark by Hall. It's in Newark. And the difference valuation of a franchise sitting in Newark versus sitting in the middle of Manhattan, that's the Hudson is the longest river in the world. It's the longest 10 miles ever. I know there's someone from the Bay Area here. I mean, the idea you got the Warriors sitting in Oakland. The Warriors were in the city. It's a different franchise. And that's football seems to survive out of the city. Baseball and basketball, I think has to be where the highest population is. So, sure.
What are the challenges in valuing the intangible assets of a franchise, and such as goodwill, and how do those valuation difficulties go into the calculations and for a sale of a team such as like the Dodgers, who used to be a marquee franchise?
Yeah, you've hit. And we get extremely technical, and I had to keep telling myself today when I was preparing for this thing is that I didn't want to get into a CPE course. But I'm going to talk as a tax guy, in the sense of goodwill from a tax perspective. The valuation of goodwill from an income tax point of view has been very simple over the years. What we used to do is we do the net present value discounts of each of the contracts, and then after everything was valued, the current assets, the fixed assets, the players' contracts and everything based on net present value, any residual of the purchase price would be goodwill. And, that's what we continue to do in tax. We take that residual number. Now, we don't include played contracts. We take all the intangibles and we put them in one group and we put them over 20 years. 15 years, excuse me. But, from now, the complexities, and if there's guys from Big Fours here, we were involved in a sports franchise. I said this a little bit earlier, that there was literally 4 different valuations of goodwill by 4 different accounting firms. And the reason is there's this new concept which us older guys just don't seem to, our abacuses go crazy when you hear this concept, is this fair value accounting. And one of the things is this thing called contributory asset charge, which is a mechanism now to where when you do a net discount present value of your broadcasting rights, to put a number on broadcasting, you have to attribute some of that to the goodwill of the business. So goodwill, they're starting to build up. And now annually, the GAAP guys have to do this impairment to make sure there's no impairment to goodwill. But the introduction of the concept of contributory asset charge is an evolution of what's going on. So and that's now, they've quantified that and you put that in a charge. But now each element of the net present value of the income generating assets are now attributable to goodwill. So goodwill is now stacking up a little bit higher than it used to be. We always have these terms. I think we spend a lot of times talking about terms when it comes to what is intangible assets. Franchise value, goodwill, whatever you want to call it. We had even a discussion this year, and one of the things is, they said, well, that should be attributable to franchise value. But then we said, well, the NBA is not technically a franchise. So what do you call it? So I hope that helped you with your question a little bit. It's a very, everything comes down to the net present value of the intangibles and how much you attribute back to goodwill.
And I'm actually going to continue on that one. So when you're looking at the impairments, or they're looking at the impairments, are they looking just at ticket price or fan affinity or brand value?
Well, they're looking at impairment at, it's evolving, okay? But impairment's looking at the same way you did it before. And then what you do is you do the same calculation of the initial purchase price, and there's an annual review to see how the impairment's done under the same exercise you did before to see if there's any change to goodwill. So it's basically using the same exercise you did before. So that impairment is basically a factor of all the, it's a macro, in fact, of all the micro issues going on within a sports franchise.
Can you just take your tax hat off for a minute and having been someone who's been around a lot of transactions, tell us a lot about the operational changes you see from old ownership to new ownership and how that changes potential value of the franchise?
Yeah, I mean, you're seeing it in something. Use the Golden State Warriors. And I don't want to get, I'll see this now that this may be on YouTube tomorrow. I'll watch what I say, and Bay Area people would agree with me. The franchise was just under the old ownership group was, just dull. And I'm a San Francisco-based guy, so, two things in life you never lose is your hometown teams and your Social Security number. And I follow the Warriors, and it was anxiety for me. When this new group has come in, a very powerful, financial, smooth, Joe Lacob, who's the owner of the team, is a passionate basketball fan. And that group will change. That franchise will be a winner. And that franchise will eventually be a substantial owner, a substantial valued franchise in the future. A lot of it has to do with the passion of the owner. We find, in my experience over the last 10 years, is I find ownership groups that have more than one owner, that have significant funds, that could keep that aren't using the team as their sole income, spend more money to make the franchise work. And we see the local team here in Boston has done very well with their group. That's a good step-up group. We'll see it with the Warriors. You'll see it in Philadelphia. And I think when you have owners that are passionate about winning, and I think winning's the game in this, you'll see the valuation go up. And I've never worked with the Clippers, so I can talk about it. But look at the Clippers as, I hear from the grapevine that they do extremely well EBITDA-wise. That it's a very successful franchise. The gentleman bought the thing for, under $20 million many years ago, and he just, he treats this as a business. It's not about winning; it's about cash flow. Now, it's not good for the fans. It's good for him and his wife and his kids. But the groups that seem to walk in and really want to spend the money and not take the money out and reinvest in the franchise are the ones that seem to increase the franchise value. We also, one of the things we've had a lot of difficulty over the years, and you could see it a little bit, what's gone on in Los Angeles, is I don't think the big corporate ownership is the way has been great for franchises. I know when I didn't particularly get involved in this transaction, I know that when they were doing the Dodgers, back when Frank McCourt bought the team, I know some of the guys that were doing the due diligence almost had to go back to the O'Malleys to get due diligence, okay? Because there was so much, intercompany charges from Fox that you couldn't even determine what EBITDA was. I think my opinion, the ideal ownership, and I'll put my tax hat back on, and the best I could do is a group of ownerships coming in together, a syndicate, to bring franchise and win it. And while they're building that franchise, I'll work on the tax aspects to give them the highest rate of return that they could possibly get with their tax dollars.
Yeah, question on revenue sharing. So revenue sharing at the league level has grown and grown, and you mentioned the Clippers. You could throw the Pirates in there, the Marlins that are being profitable because they're getting a share of revenue from the league. How has that affected the valuation of these franchises, especially as it's evolved in the last 10 or 20 years in sports?
Well, it's what you're doing is you're saying, like, if because they get a share of the national broadcasting rights on any particular team, it takes away from the cash of the most people that watch the teams. And you're saying so that what the team is getting a share of someone else's. So the teams that are giving up that revenue does it hurt their valuation because they're in this revenue share? We'll talk on both sides of that. I don't think so, because if you didn't have these revenue shares, you wouldn't have any other teams except yourself to play in some instances. Okay, I mean, some of these teams are really starving, and they need that share to survive. These smaller market teams, and if you need the competition, and then you get the national broadcasting. We have an issue going on now, which is kind of an interesting point, is state and local governments, as everybody's probably aware of, are really trying to get revenue in. And so for the first time, someone asked me a question, it says, well, how come the NBA franchises don't do tax returns or pay taxes in all the states they pay in? Well, because we don't take the position we do business in those states. So a lot of states we've been excluding, and the states have been really attacking lately. So the state of Texas, who doesn't have an income tax but now has this Texas margin tax, did a study on the national broadcast through Nielsen of how many people were watching, from particular instances in the state of Texas, NBA basketball teams. So it was determined, and this is something that's going to surprise the room, is that most NBA audiences is not California or New York, it's Texas. So Texas has so what they did is they took all the revenues and they allocated that revenue to Texas, because Texas controls 10%. So every team now has to pay this awful thing called the gross margin tax in Texas. And when we first got involved, it was a very harsh tax until we lobbied down on it. But, you need the small market teams to stay in the business. So it helps the small market teams do it. It's, some small market, Boston's not it's a very fanatical market, but it's not a big market. But, the number of users here and the number of fanatics, I married a woman from Boston, so I know. There's your mom, your dad, God, and the Red Sox, and it's not in that order, and it's in the blood. And was there 8 to 9 billion people in this area, in the sense of a metropolitan market? And I'd say the percentage of people that watch the sports franchise business is higher than any normal area in the United States. It's phenomenal, But I hope that answered your question. You kind of need the income in those small market teams to keep the teams playing, and because they don't have the ticket sales. If you're out in Kansas City, you have trouble getting good ticket prices. So you have to stay within that market. You can't, Madison Square Garden these days, it's almost like Fenway Park. To get a ticket, you almost got to pay $1,000 to go to a game. If you want to go see the Knicks play, go to a small market team, okay, and watch them play. It's cheaper with the airfare and the hotels these days. So, yeah.
With the Houston Texans, I think they bought into the league at $700 million. So I guess that puts like a starting point on the valuation of the Houston Texans. Now, how do you think the NFL is deriving that figure, or other leagues are deriving that initial figure?
Well, we kind of go back to the earlier part of the speech. I think a lot of the announcements that come out of commissioners' offices are public relationship numbers that come out to show that there's an enhancement to the value of the franchise. And I don't know that particular deal, and you don't know if the stadium's included, what's in the stadium, how the price is determined. But, the announcements that you see is not usually the real purchase price. So it's hard to say, but they're close. But like I said earlier, the ones that I have seen, you see the commissioner's office announcing numbers where I've seen that aren't even close to some of those numbers. And then everybody has their interpretation of what purchase price is. There is a true definition of purchase price. It's going to be, if you bought everything clean, it's going to be what's on the right side of your balance sheet. And our profession is very simple. It has to balance. And here's your assets, and here's your liabilities and equity. When you buy the team, the value is going to be what equals to what your equity and liabilities you did to acquire the team, and that includes assuming operating costs. So I would have to take a look at the particular deal to see what's made up of it. So, good. Thank you.
I learned my finance and accounting classes were not useless, so I appreciate that.
Thank you very much.
Would like to join me in thanking Mr. Joe McNulty. Thank you very much. Well done, sir.